Hi, this is Vijay Bambwani and I'm recording this video from the safety of my house. I'm staying indoors and I'm obeying the lockdown instructions. I hope you are looking after yourself and your family and keeping safe and staying indoors also as is required in the lockdown. Now this video is something that came to my mind after I read some news in the media about the Franklin Templeton debt fund issue. If you remember, I have been talking a lot about the debt market, about investing in bonds, and how rich traders do not allocate all their money into equity schemes, but also keep a significant asset allocation to bonds. Do remember the words that I use out there. Sovereign bonds. Sovereign. Now, sovereign, if you open the dictionary, would tell you is the name for the king or the government. Now, when we are talking about sovereign bonds, we are talking about bonds that are issued and guaranteed by the government of the day. Now, I'm sure a lot of my video viewers would be sort of concerned about the fact that Franklin Templeton, a very respected name in the mutual fund business, has announced the sudden and abrupt closure of 6 of their debt fund schemes. And these are schemes of various hues, various maturities, and their charter would mean the memorandum and article of association of a fund as to what it will do, where it will invest money, and what it does with the money provided by the unit holder in its lifespan. So these are 6 dissimilar but not very, very different fund schemes with an asset under management, which is AUM in the mutual fund parlance, of approximately 28,000 crores. This is not exactly loose change. So I can understand that there are concerns amongst the investors as to what will happen next. Please do remember, as I told you in the beginning of this video, that as a mutual fund of the size of Franklin Templeton, I think it is very natural for the fund manager to split the money into various type of bonds and various type of debt schemes, which means the money is not just in government bonds, but there is also a whole lot of private and corporate paper involved. There would possibly be also some monies lent out to corporates also. Now, this is where the crux of the problem lies. Corporate debt or corporate bond, corporate paper, call it what you may, different names, same meaning. So, same difference. Call it what you may, but this is not guaranteed paper. It is payable when able. So, it is obviously yielding higher rates of interest because the risk element in this investment is higher. And therefore, the fund manager needs to be rewarded for taking the higher element of risk, which is why the payoff tends to be a little higher. This is where the problem lies. Now, in the investment industry, I'm talking of investments and not trading. Do make a note of this, please. In the investment industry, an investor needs to take care of 2 primary things. Return of capital, which means your principal amount. In Hindi, it is called muddal, which means the principal. The principal must be safe and you must get it back when you want it back, or it is due to be paid back to you. So return of capital should never be under doubt. Then the second element is return on capital. On capital is the profit, the interest, or the yield. Call it by different names, same meaning. Hindi, you may call it vyaj or interest. The return on investment or return on capital is a secondary issue. You should first focus on protecting or safeguarding or ring fencing your capital first. Your capital is your holy cow, which can never be sacrificed. Which is why a lot of investors who've succumbed to the temptation of looking at return on investment or return on the capital, which is higher interest, are likely to come to grief because there might be potentially a cascading effect as there is a run on other mutual funds as well. There is something called herd mentality in the market. In Hindi, it is called bhed chal. Bhed would mean herd, goat, a herd of goats. So bhed chal would means just as a herd of goats or sheep tend to crowd around in the same direction. So is there a possibility of other debt funds also facing redemption requests? Yes, I think so. Which means that even if a debt fund is not into as much of a problem, sentiments are likely to turn negative. And what would then happen to sovereign bonds? There would be a flight of capital out from private bonds and into sovereign bonds, which means private bond prices will come down, their yields will go up, the return will go up, because a 100 rupee bond, hypothetically, if it comes to 50 rupees, the interest of 10% on that 100 rupees would still be payable to you. So your yield, which was earlier 10%, would now become 20% because the bond price has become half. So the private bond market would see bond prices come down and yields go up. On the other hand, sovereign bonds would witness an inflow. People would pull money out of corporate bonds and invest in the sovereign bonds, and their prices will go up. Once the sovereign bond prices go up, the yield will fall down. Hey, if you check the yield on sovereign bonds yesterday, it's now come down sharply by 20 basis points, no less. Which means that my hypothesis of sticking to quality paper and sovereign debt which is guaranteed by the President of India, which is the central government of India, and sovereign also, by the way, means state government guaranteed debt. These are bonds issued by the RBI. You are as good as giving money to the government of India or government of the state where you reside. This money is still safe. By now, you know, thanks to the white hair on my head, I'm 54 years old, by the way. I've been in this market since 1986. I depend more on safety of my principal than the return on investment. I've learned the hard way through hard knocks in life that I must protect my capital first. And now, in times of corona, protection of life becomes primarily. So, stay indoors, obey the lockdown instructions, stay safe, stick to sovereign debt. Do take very good care of your investments, your trades, and your health. Vijay Bambwani, before I sign off for now, request you to click like on this video if you're watching it on YouTube. In the comment section, do let me know what you think about this video and what you want me to record in my future videos. Do not forget to share these videos with your family and friends and spread the cult of knowledge-based investments. Also, join me on Equity Master's Telegram channel with the handle Equity Master Official. I post a couple of updates every day, Monday to Friday, and I'd love you to read my posts. Thank you. Stay safe. Bye-bye.
Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.